Picture this. It's March 2024, and a leaked document from a private wealth management firm in Manhattan reveals something shocking. The portfolios of their billionaire clients look nothing like what financial gurus have been telling you. Some hold zero real estate. Others have dumped 60% of their stock positions. And here's what keeps everyday investors up at night. Are you building wealth on the wrong foundation? Is your retirement fund betting on yesterday's winning strategy while the ultra-wealthy have already moved their pieces on the board? What do they see coming that you don't? Stay with me, because what I'm about to reveal will completely change how you think about building wealth, and the clock is ticking on this window of opportunity. For decades, you've heard the same advice repeated like gospel. Buy real estate. You're not making any more land. Or the stock market always goes up over time. But here's the uncomfortable truth that nobody wants to admit. Both statements have destroyed more wealth than they've created, and timing is everything. Let me show you something that'll make your stomach drop. In 2008, American homeowners collectively lost $9.8 trillion in property value. Yes, trillion with a T. Foreclosures hit 3.8 million. People who believed real estate was always safe watched their net worth evaporate overnight. But here's the twist. Between 2007 and 2009, while real estate crashed, billionaires like Warren Buffett and Carl Icahn were stockpiling stocks at bargain prices. Fast forward to 2022, and the script flipped. The stock market shed $7.6 trillion in value. Tech stocks that made people millionaires in 2021 were down 70%, 80%, even 90%. Meanwhile, real estate in certain markets stayed resilient. So which is it? Where do the truly wealthy actually put their money? The answer is more complex and more actionable than you think. Let's pull back the curtain on real estate first, but not the way your local real estate agent explains it. When Larry Ellison, founder of Oracle, spent over $300 million buying up 98% of the Hawaiian island of Lanai in 2012, was he making an emotional purchase? When BlackRock and other institutional investors spent $60 billion buying up single-family homes between 2020 and 2023, were they following a hunch? Absolutely not. They understand something critical about real estate that most people completely miss. The ultra-wealthy don't buy real estate the way you and I do. They use depreciation to shield income from taxes, writing off $10,000, $50,000, even $200,000 per year on properties that are actually appreciating in value. They use 1031 exchanges to defer capital gains taxes indefinitely, rolling profits from one property into another without the IRS taking a cut. And here's the real secret weapon: leverage. They put down 20-30% and let tenants pay the mortgage while building equity on 100% of the property's value. If a $1 million property appreciates 5% annually, that's $50,000 in gains on maybe $250,000 of their actual money, a 20% return on their invested capital. The math is intoxicating, isn't it? But wait, before you rush to become a real estate mogul, let me show you the trap that's waiting. Real estate has a dark side that destroys unprepared investors. And I'm not talking about bad tenants or surprise repairs. I'm talking about liquidity, or rather, the complete lack of it. When the market turns, when you need cash, when opportunity knocks, your equity is locked behind months of selling processes, inspections, negotiations, and closing costs. In March 2020, when COVID hit and cash became king, stock investors could liquidate positions in seconds. Real estate investors? They watched properties sit on the market for months while prices dropped. Some couldn't sell at any price. And here's what nobody tells you about the passive income dream. Being a landlord is a second job unless you're wealthy enough to hire professional management, which eats 8 to 12% of your rental income. Then there's the concentration risk. If you have $500,000 and you buy 2 properties, your entire net worth is concentrated in 2 buildings, in 2 neighborhoods, subject to the same local economic forces. What happens when the major employer in that city relocates? When local regulations change? When climate patterns shift and insurance costs explode? Florida homeowners learned this the hard way in 2024 when insurance premiums doubled and some insurers simply abandoned the state. So if real estate is this complicated, maybe stocks are the answer. The stock market tells an equally fascinating story, but with a completely different playbook. Warren Buffett, worth over $120 billion as of 2025, still lives in the same house he bought in 1958 for $31,500. His real wealth? It's in stocks, specifically Berkshire Hathaway shares and the companies Berkshire owns. Jeff Bezos, Elon Musk, Bill Gates, their billions are predominantly in equities, not real estate empires. Why? Because they understand the most powerful wealth-building force in human history: compound growth. Let me paint you a picture with real numbers. If you had invested $10,000 in the S&P 500 in January 1980 through crashes, recessions, dot-com bubbles, and financial crises, by January 2025, you'd have approximately $1.4 million. You did nothing. No tenants, no repairs, no management. The average annual return was roughly 11.5%. Real estate over the same period? Approximately 4 to 5% annually on average nationwide, and that's before expenses. But here's the advantage that changes everything for stocks: liquidity. When Elon Musk needs cash, he doesn't sell a mansion and wait 90 days. He borrows against his stock portfolio or sells shares, executed in seconds. When opportunity emerges, stock investors can pounce immediately. They can diversify across 500, 1,000, even 5,000 different companies, spreading risk in ways real estate investors can only dream about. So stocks win, right? Not so fast. The stock market nearly destroyed a generation of wealth in 2022, and here's why it terrifies even billionaires sometimes. Between January and October 2022, the S&P 500 dropped 25%. The Nasdaq, loaded with tech stocks, plummeted 33%. If you were planning to retire, if you needed that money, if you panicked and sold, you locked in catastrophic losses. And it gets worse. Individual stocks can go to zero. Lehman Brothers, Enron, countless others completely wiped out. Your rental property might lose value, but it doesn't vanish. You still own a physical asset. Then there's the emotional warfare of watching your net worth swing by thousands or tens of thousands of dollars daily. Can you stomach a $50,000 portfolio loss in a single day and not panic sell? Most can't, which is why the average investor dramatically underperforms the market, chasing hot stocks, selling in fear, buying in greed. Fidelity Investments did a study and found their best performing accounts belonged to people who were dead or had forgotten they had accounts. Let that sink in. So if both have massive flaws, where do the rich actually put their money?
Here's the revelation that will transform your entire strategy, backed by hard data. According to the 2024 Knight Frank Wealth Report, analyzing ultra-high net worth individuals, those worth $30 million or more, the average portfolio allocation is roughly 26% in real estate, 23% in equities, with the rest spread across bonds, private equity, alternative investments, and cash. They're not choosing one or the other, they're strategically using both. But here's the critical detail. They adjust these percentages based on market conditions, age, and specific opportunities. Ray Dalio, founder of Bridgewater Associates, pioneered the all-weather portfolio concept, diversification across asset classes that perform differently in various economic conditions. When stocks crash, bonds might rise. When inflation surges, real estate and commodities often protect wealth. The wealthy think in ecosystems, not individual bets. In 2020, when interest rates dropped to historic lows, smart money loaded up on real estate, locking in cheap debt on assets that would appreciate as inflation hit. In 2022, when stocks crashed, they were buying the dip while everyone else was selling in panic. In 2025, with interest rates stabilizing and AI transforming industries, they're rebalancing again. The game isn't about picking the winner, it's about positioning yourself to win in multiple scenarios. But there's one factor that matters more than any asset class, and it's the one nobody talks about: taxes and leverage. These are the silent wealth multipliers that separate the rich from everyone else, and here's how they use both assets differently. Real estate offers depreciation, a phantom expense that reduces taxable income without any actual cash leaving your pocket. You can write off $36,000 annually on a $1 million commercial property through depreciation, lowering your tax bill by $10,000 to $13,000, depending on your bracket. Stocks? You only pay capital gains tax when you sell, and if you hold over a year, you pay long-term rates, 15% for most people, compared to ordinary income tax rates up to 37%. But here's the move the ultra-wealthy use. They borrow against their stock portfolios at 3 to 5% interest rates, never sell, never trigger capital gains, and use the borrowed money to invest in opportunities or fund their lifestyle. It's called buy, borrow, die, and it's completely legal. Meanwhile, real estate investors use leverage differently. They control $1 million in assets with $200,000 down, magnifying returns, but also magnifying risks. A 10% increase in property value means a 50% return on their down payment, but a 10% decrease means they're underwater. The inflation factor adds another layer. From 2020 to 2024, inflation ran hot. Real estate generally kept pace or exceeded inflation in many markets, while stocks had mixed results depending on sector. Fixed-rate mortgages became golden tickets as you paid back loans with increasingly cheaper dollars, while rents rose. But here's what determines whether this works for you or destroys you: time commitment. Are you ready for what this really takes? Real estate demands active engagement unless you have serious capital for professional management. You're dealing with tenant issues, maintenance calls, local market research, property taxes, insurance renewals, and regulatory changes. It's a business, not a passive investment, until you reach a certain scale. Stocks, particularly index funds, require almost zero time commitment. Set up automatic investments, rebalance annually, ignore the noise. That's it. For someone working a demanding career, building a business, or raising a family, stocks offer wealth building that doesn't steal your time. But here's the trap. During market volatility, the time you save gets spent obsessively checking your portfolio, reading doom and gloom headlines, and making emotional decisions. The liquidity that makes stocks easy to buy also makes them easy to panic sell. Real estate's illiquidity becomes a forced discipline. You can't panic sell a duplex on a Tuesday afternoon because the market dropped. So, knowing all this, what should you actually do? The answer depends on 3 critical factors: your current wealth level, your age, and your risk tolerance. Let me break this down specifically. If you're sitting on less than $100,000 in investable assets, here's the truth. Stocks and index funds should be your primary focus, specifically low-cost index funds tracking the S&P 500 or total market funds. Why? You need liquidity, diversification, and growth without the time commitment. Real estate requires more capital to do safely: down payments, reserves for repairs, cushion for vacancies. One bad property decision at this wealth level can be financially devastating. Build your stock portfolio first. Get it to $150,000 to $250,000, then consider adding real estate. If you're between $100,000 and $1 million, this is where it gets interesting. You can start incorporating real estate strategically, maybe a rental property or 2, REITs for real estate exposure without landlord duties, or crowdfunding platforms that let you invest in commercial real estate with smaller amounts. Your stock portfolio should still be the foundation, maybe 60 to 70%, but you're diversifying into real assets. Above $1 million, you have the capital to play the game like the wealthy do.
multiple properties, professional management, tax strategies, and a diversified stock portfolio working together. Your age matters enormously too. In your 20s and 30s, you can stomach volatility, lean heavier into stocks for growth. In your 40s and 50s, balance becomes critical. Build that real estate component for income and stability. In your 60s and beyond, you need income and preservation, dividend stocks, paid-off rental properties, bonds. The wealthy shift their allocation through life stages, and so should you.
But here's the final piece that determines everything, and it's something nobody can answer for you: your risk tolerance and personality. Can you sleep at night knowing your net worth swings by 20% in a year? Then stocks might suit you. Do you need to see it, touch it, control it? Real estate might be your game. The billionaires I've mentioned didn't succeed by copying someone else's playbook. They succeeded by understanding themselves, understanding markets, and positioning accordingly. Right now, in February 2026, we're in a unique moment. Interest rates are stabilizing after years of volatility. Stock valuations in certain sectors are attractive. Real estate in some markets is softening while others remain tight. AI and technology are reshaping industries, creating stock opportunities and disrupting real estate through remote work patterns. The wealthy are positioning right now for the next decade. The question is, are you? Here's what I want you to ask yourself before you close this video. Am I building wealth intentionally with a strategy, or am I just hoping it works out? Because hope isn't a strategy, and time is the only asset you can't buy back. Subscribe to this channel if you want more unfiltered insights into how wealth really works. Not the Instagram version, but the data-backed, strategy-driven truth. Hit that like button if this changed how you think about investing, and drop a comment below. Are you team real estate, team stocks, or team both? What's your wealth building strategy for 2026? I read every comment, and your perspective might be the insight someone else desperately needs to hear. The path to wealth isn't mysterious, it's methodical. And now you know what the rich know. The only question left is, what are you going to do about it?